If one day the world's data centers consume as much electricity as an entire nation, what will the energy market look like? AI's demand for compute power is growing at a speed no one has ever seen, yet the number of energy sources that can truly sustain that demand is small. Some investors are betting on wind and solar, others on natural gas, but the real answer might lie in a corner most people still overlook. It doesn't stand out on the surface, but it could decide who captures the biggest prize downstream. And yes, you've probably guessed it, the answer is nuclear power. Hi everyone, I'm Cairo, your trading guide who breaks down the US market piece by piece. If you've been following me, we've already talked about the upstream and midstream parts of the nuclear chain. Today, we'll move to the downstream, the part where nuclear power's value truly gets realized. Before we dive in, just a quick reminder, everything I share here reflects my own views and analysis. Nothing in this video should be taken as investment advice. The market carries risks, and any real-world decision should come from your own independent thinking and judgment. When we talk about nuclear power, the industry is generally split into three sections: upstream, midstream, and downstream. Upstream includes uranium, fuel, and other critical materials. Midstream covers reactor, manufacturing, construction, and engineering services. Downstream is the final link, generating electricity, selling it, delivering it, and turning it into cash. Each part matters, you can't separate them. The key feature of downstream is cash realization. Upstream tends to be capital intensive and long cycle, while midstream often relies on long-term contracts to stay steady. Downstream is much more direct. Once the power is generated and sold, revenue starts flowing immediately. Think of it like this. Upstream is the building the car stage. It burns money and takes time. Midstream is assembling the car, progressing step by step. Downstream is when you start collecting the fares. The power plant generates electricity, the grid sends it out, users pay their bills, and the cash comes in. In terms of visibility and predictability, downstream is usually the clearest and easiest to measure. Its first job is to convert all that supply from upstream into actual output. It turns nuclear fuel and equipment into usable electricity. How much power it produces and how efficiently it runs are the most straightforward metrics to track. And nuclear has one huge advantage: it can run 24 hours a day. Unlike wind or solar, which depend on weather conditions, its second job is to sell the power. There are many ways to do this: selling to the grid, signing direct deals with large industrial users, locking in prices through long-term contracts, or trading on spot and capacity markets. Each method shapes the stability and flexibility of revenue. The third job is to make sure electricity reaches the places that need it most. AI data centers and semiconductor plants will be the main sources of new demand. Whether nuclear providers can deliver steady power directly to them through dedicated lines or direct supply agreements will decide who captures the most downstream value. So my view is this: every segment of the chain matters, but the downstream is where everything connects. It absorbs the output and build out from upstream and midstream, and it links directly to end demand. It's where electricity becomes cash. Among all parts of the nuclear value chain, it's the one with the highest certainty and the one most worth analyzing closely. If we break down the downstream segment, it can be divided into several core parts, and I'll go through them one by one. The first group is nuclear power operators. These are the companies that actually run nuclear plants and turn uranium into electricity. In simple terms, they determine how much power can ultimately be sold, so their revenue scale is directly tied to how much electricity they produce. The two key metrics that matter most here are total generation and utilization rate. One of nuclear's biggest advantages is stability. It doesn't rely on the weather like wind or solar does, and it typically runs around the clock, achieving capacity factors above 90%. As long as the plant doesn't encounter major maintenance shutdowns, generation remains steady. That said, even temporary refueling outages lasting a month or two can have a visible impact on annual revenue. So when evaluating these companies, you have to look not just at their capacity, but also at their operational stability. The second group focuses on power sales and trading. Once the power is generated, it has to be sold either to the grid or directly to large-scale users. That's where trading comes in. Some companies lock in long-term power purchase agreements or PPAs at stable prices, guaranteeing predictable cash flow for years or even decades. Others participate in more market-based trading, spot markets, power futures, or capacity markets to chase high returns. What you want to watch here is how each company balances stability with flexibility. Long-term contracts give you steady income, but limit upside when electricity prices spike, while spot trading captures those high points but increases volatility. The most skillful players combine both a stable foundation underneath and tactical flexibility on top to capture market peaks when they happen. The third group lies in the power grid and electrification solutions. Generating electricity is one thing, but you still need to deliver it. That's where grid infrastructure comes in. Nuclear is a base load source. It produces steady output, but plugging it into the grid isn't simple. The grid must have enough transmission and dispatch capacity to handle it. As nuclear's share of total power grows, the grid has to be upgraded and digitized. Otherwise, we'll face situations where power is generated but can't be delivered. At the same time, electrification is accelerating, and that means more demand for storage systems, smart dispatch, and digital optimization. Grid companies and electrical solution providers step in here. They don't make money by selling power, but by collecting transmission fees and offering long-term services for grid upgrades and electrification systems. The last category is end-use demand, and here two sectors stand out: AI data centers and the semiconductor industry. AI data centers will be the biggest source of incremental power demand over the next few years. As we've discussed before, the explosion in compute has sent data center electricity use skyrocketing, and their requirements are extreme. Power must be perfectly stable 24 hours a day, year-round. That makes nuclear the ideal source. The same logic applies to semiconductor fabs. A single power interruption can cause millions in losses per M in newt. For them, reliability matters even more than price. That's why we're seeing more data center operators signing long-term nuclear PPAs, locking in energy supply for the next decade or more. To them, electricity isn't a cost, it's a lifeline. So to sum up, each part of the downstream chain connects tightly with the others. Operators run the plants and generate power, sales and trading determine how it's sold, the grid ensures it's delivered safely and efficiently. End users convert that electricity into real cash flow. And throughout that process, stability and predictability are nuclear's greatest advantages over any other form of energy. Now, let's look at specific companies operating in these areas. Starting with the nuclear power operators, the most prominent example is Constellation Energy, ticker SEG. It's the largest nuclear operator in the United States, running more than 20 reactors across the East and Midwest, providing nearly 1/5 of America's clean energy supply. Its strength lies in scale, a heavy reliance on nuclear generation, and long-term power contracts that lock in cash flow, making its income remarkably stable. Another key point is that CG isn't exposed to coal or natural gas, so it benefits directly from clean energy policy incentives. Next is Public Service Enterprise Group, ticker PEG, serving New Jersey and New York. Its nuclear capacity is smaller than CIG's, but still critical to the region's grid stability. Local households and industries rely on it heavily. PEG benefits from strong regulatory and policy protection, giving it consistent profitability. Then there's Exelon, ticker X. It used to be part of the same company as Constellation before splitting off, retaining the retail and transmission side of the business. Exelon still has a large share of nuclear in its generation mix and remains one of the key anchors of power stability in the eastern United States. Together, CAG, PEG, and XE are essentially the three pillars of the Northeast power system. In power sales and trading, the standout is NRG Energy, ticker NRG. Its core strength isn't in owning plants but in market flexibility. It operates a mix of stable nuclear baseload and variable renewables, like wind and solar, then optimizes that mix through trading. NRG packages different power sources and sells them to grids and corporate clients. This approach locks in baseline profits while giving room to earn extra when market prices rise. In other words, NRG acts as both a power operator and a trader, a model well suited for deregulated and market-driven energy environments. Another name worth noting is Vistra, ticker VSST, which follows a similar multi-energy and trading strategy but at a larger scale, with broader retail coverage. Because of that, Vistra tends to react the fastest when power prices move. Moving to grid and electrification, there's GE Vernova, ticker GEV, recently spun off from General Electric. Its positioning is clear. It provides the full ecosystem from energy equipment to grid systems to electrification solutions. GEV doesn't generate electricity itself. Instead, it supplies the technology that keeps nuclear, wind, and solar connected and stable. As nuclear share rises, grids will need massive upgrades and smarter systems to absorb that power. This part of the chain is often ignored, but it's absolutely vital. GVIS is like the company selling shovels during a gold rush. It profits no matter which energy source leads the transition. Finally, the end demand segment. Here we look at the utilities that deliver power directly to homes and industries. Duke Energy, ticker DUC, is one of the largest utilities in the southeastern United States, serving more than 7 million customers. It runs its own nuclear fleet and also purchases outside power to feed its network. For investors, Duke's main appeal is its huge customer base and predictable pricing structure. In other words, a locked-in market with steady demand. Another important player is Southern Company, ticker. So it holds a special place in US nuclear history. Its Vogtle Units 3 and 4 are the first new nuclear reactors to be built and activated in the US in decades. Southern Company integrates generation, transmission, and retail, combining all stages of the power business. Its nuclear assets provide reliable cash flow that offsets volatility from other energy sources. One more name to mention is Next Energy, ticker NE. It's smaller in size but focuses on cutting-edge innovation, small modular reactors, and distributed nuclear energy solutions. It's still early stage, but if the industry moves towards smaller, more flexible reactors, companies like this could become future dark horses. Put all these together and you can see how they form a complete ecosystem: generation, trading, grid, and end demand, each part reinforcing the next. From an investment perspective, the downstream offers the highest visibility and stability. Once demand explodes, these are the companies best positioned to turn it directly into profits. When we talk about future opportunities in the downstream nuclear sector, there's no need to overcomplicate things. You just need to focus on a few key factors. First, will AI's electricity demand continue to expand? Is AI just a short-term hype cycle or a lasting structural trend? That question determines whether downstream companies can keep growing. Personally, I believe compute power demand will become increasingly rigid. Even if AI applications take longer to commercialize, the rise of data centers and electrified infrastructure is already locked in. So the demand foundation is solid. Second, we need to look at how nuclear and renewables will coexist. The future of energy will be a mixed grid, nuclear as the baseload, wind and solar as the complement. The companies that can balance this combination will enjoy more stable earnings. I tend to favor those with a higher nuclear share, but that are also expanding into renewables because they can benefit from both policy incentives and market momentum. Third, one of the most important variables is how electricity pricing and trading mechanisms evolve. In the past, power companies were seen as boring, just producing and selling electricity, but the future is far more market-driven. Some firms now blend long-term contracts with spot and capacity trading to balance risk and reward. Companies like NRG Energy are great examples. They face more volatility, but if managed well, they can profit directly from it. The key is not avoiding volatility, but mastering it. And finally, we have grid modernization. This might sound dull, but it's actually the choke point of the whole industry. It doesn't matter how much nuclear capacity you build. If the grid isn't upgraded, that power simply can't be transmitted. That's why I'm watching companies like Vernova closely. They're essentially doing the infrastructure makeup work. It may not look glamorous, but it's absolutely essential. So, to sum it up, I personally focus most on two short-term drivers: AI's power consumption and changes in electricity pricing mechanisms. These two factors move stock prices fastest and show up directly in earnings results. The rest, renewable integration and grid upgrades, are longer-term trends to track alongside. Of course, no industry is risk-free, and downstream nuclear is no exception. The first risk is policy and regulation. Electricity pricing and carbon emission policies can directly impact profitability. While the long-term direction clearly favors clean energy, short-term policy shifts, like changes in subsidies or pricing formulas, can still introduce uncertainty. The second risk lies in operations. If a nuclear plant experiences an outage or unexpected maintenance shutdown, generation drops immediately and revenue takes a hit. These events are rare but real. When they happen, the impact is tangible. The third risk is capital expenditure. Grid upgrades and data center expansions require heavy upfront investment with long payback cycles. It's not something that yields instant returns. Companies need time to digest the spending. My view is simple: these risks shouldn't be ignored, but there's also no reason to panic. The long-term direction of the industry remains intact. What matters most is whether management teams can pace themselves properly and keep risks within a reasonable range. Now that we've talked about risks, the next question is timing. How do you think about opportunities across different time horizons? Nuclear and power generation aren't short sprints, they're long distance runs. In the short term, I'd focus on electricity prices and data center demand. Why? Because these two directly lift revenue. For example, companies like Constellation Energy, ticker SEG, or large data center operators such as Digital Realty, DLR, and Equinix, if power demand spikes, their numbers respond almost immediately. In the midterm, the focus shifts to whether nuclear share in the overall energy mix is genuinely rising and whether market-based trading is becoming more active. At that stage, companies like NRG Energy or Public Service Enterprise Group, ticker PEG, might benefit the most because of their flexibility in trading and price arbitrage. And in the long term, the most imaginative opportunities will come from the combination of grid upgrades and the AI energy ecosystem. The grid needs to become smarter and more stable to handle rising nuclear output, and that's where companies like Vernova, ticker GIV, stand to gain. Once those projects start rolling out at scale, the upside could far exceed what we're seeing today. So my advice is, don't expect to capture every benefit at once. Each stage has its focus. Be patient. Opportunities will emerge one by one. Before we wrap up, I want to emphasize something. I don't make these videos to hand out buy lists. What I really care about is helping you understand the logic behind the market, so you won't be driven by emotion or get lost in the noise. My goal from day one has been to help investors avoid pitfalls and make sense of complex topics quickly. You shouldn't need hours of research just to understand what's going on. Whether you invest or not is entirely your choice. I'm just here to offer a different perspective. And if you'd like to explore investment opportunities together or just share your thoughts on the market, drop whatever's on your mind in the comments below. And don't forget to subscribe to my channel. That's all for today. Thank you for tuning in. I'm Cairo, and I'll see you in the next video.